Hello everyone, in this video we would be beginning with a new playlist that is CMT level 2 Chartered Market Technician level 2, and in this particular video we would be doing the chapter number 1, that is understanding data intervals, and then we'll move on to the chapter number 2 and the chapter number 3. So the aim in this particular video is to complete these 3 chapters. I would be discussing the most important things in this topic, and the way we will be approaching these chapters or this entire course is through referring to the charts in trading view. So every now and then, after every concept, what we'll do is we'll go on the trading view, because our aim is to uh, get better at the applying the concepts, because this will also help us in our personal trading and the exam. So this exam is mostly application based, which means that just learning the theory is not enough. They are going to test and they're going to see how you are going to apply it in your actual trading. So what you need to do is have a pencil and a paper and try to make notes. Whatever you think is important, then pause the video and note it down. And if you have any queries, you can drop it in the comments or you can email me. You can find my email. And I will also try to make very short recap notes on the notes app. So make sure to side by side make the notes. Okay, so the first chapter is extremely easy. We will finish it in like I think less than 10 minutes, because this is something we've already done in level 1. So understanding data intervals. So when we talk about data intervals, we are referring to the different kind of time frames which are there when you are trading. So whenever you are trading, you know that you can set your candlestick charts to different time frames. It can go as low as 1 second to as high as 1 month, 1 year, and so on. So if I go on my trading view, let's go on Titan. That's just a random chart which I opened. So let me remove my indicators and everything. Okay, look at this now. So do you see this time frame? These are the time intervals, right? So you have a lot of options to choose from. Depending on your particular trading style, you can choose the time frame. So right now I chose a 15-minute time frame, which means that each candle is referring to 15 minutes. Okay, so the learning objectives, multiple data intervals. So whenever you are taking a trade, it is always advisable to confirm the direction from multiple time frames. So that is one thing to keep in mind. Compare the typical construction of a weekly and monthly interval charts. So we anyway know that the opening price of a weekly chart would be the starting of the week, and the closing price would be the ending of the week, and the high and the low, that is the upper wick, and the lower wick, that would be the high and low of the particular week. And if it's a monthly candle, then it would be for a month. So that is how they are constructed. I'm sure everybody knows it because you have cleared your level 1. So then we'll also be looking at what kind of challenges we will be facing when you are looking at time based charts, especially on the intraday level. And then we'll see trend relationships with multiple price data sets. So what do you understand by multiple price data sets? When I am plotting two different prices of two stocks, when I am plotting the prices of two different stocks on the same graph, to see the correlation and to compare both of them. And then we will see what a scatter plot is. So what you must have understood by reading the learning objective statements is that you have already done all of these in your level 1, which is why I said that this is going to be a very short thing. Okay, so we all know what technical analysis is by now. Technical analysis is the study of the price movements. So price is discounted. We know that price contains all the information, including the fundamental information, which is why we rely on technical analysis, because it is an assumption and we believe that price already contains all information which is required, right? And the supply and the demand of the stock and the price behavior and everything. So now that is depicted in the price of the stock, which we use to make any sort of decisions. So that is to begin with. Okay, now we have what is data intervals. So data intervals is again what we have discussed, that it is the different time frame. So now we come to another concept, which is the noise. What do you understand by noise? Noise is basically the movements which do not have any significant meaning. So for example, people say that daily chart is the cleanest chart and people must use daily chart, right? So if I look at the daily chart, this is how my daily chart looks, right? Look at it. It's very clear, right? We can see Titan is in a clear uptrend. Now if I go on a 3-minute chart, the same thing is in a very erratic motion, right? Here it is in a downtrend towards the end. But if you go on the daily chart, it is still in an uptrend. So all these noise which occurs on lower time frames is all clear if you use a higher time frame. In the higher time frame, this noise of the lower time frames of the intraday noise is avoided and everything is very clear. So that is our concept of noise. Okay, and then we will go to the figure which they have given. So look at this. I know it's not clear, but I will explain it to you. It's very basic. So this is a line graph which they have used, right? So this is the monthly chart of the Apple, NASDAQ. Apple is listed on the NASDAQ, right? On the US stock exchange. So you can clearly see that the stock of Apple has been in an uptrend on a monthly time frame, right? And you can also see that during 2020, this is during 2020, you can see that the price went down for a bit. So it has been rising clearly, but here it took a big dump. Now why did that happen? Obviously because of COVID, right? During COVID it took a dump uh, in March 2020, and that was when it took a small correction, and after that you know that it picked up again. So that is how you use line graphs. And now if you look at the candlesticks, now candlesticks are always better, so let's just see on the real chart as well. Now the reason why I am referring to the real charts is because end of the day you need to trade in the real charts, right? So that's what really is important to know. So this is a monthly chart of Apple. It is listed on Nasdaq. So look at this, how it's been going up ever since. Like this is you can see the time, right? March 2012. From there on it has been only rising and it has been going up, and currently it's trading over here. And if you can see, in 2020 it did go a little bit down, but then it picked up again. So that is our monthly time frame. So the that is my candlestick. And in case somebody wishes to see the trend more clearly, you can change the candlestick chart to a line chart. See, when you change it to a line chart, you can just clearly identify what trend is going on. So that is the reason why most of the traders use the candlesticks, because candlesticks give detailed information and it is very good to use. But then line chart will give you a clear trend direction. Okay, so then, right, so that's what they're saying, that if we would have purchased Apple during the last several years, then you know that we would have been at a very big profit. Why? Because there has been a crazy uptrend going on, right? But then you need to keep in mind that entry is not the only thing that matters. We also need to exit at the correct time. Imagine if we wouldn't have exited, right? If you wouldn't have exited, then let's just go on a 15-minute chart, okay? And if you look at the chart over here, okay, so let's assume that you entered over here, okay, the price went till here. If you would have exited over here, you would have been at a profit. But imagine you didn't exit and you exited over here, you would have been at a loss. So you need to also have a very good exit condition. All right, moving on. All right. So when we have a long period chart, so like we just saw a monthly chart, right? So why do we actually use a longer time frame? Because when we use a longer period of trading, then they are good at showing long-term trends, right? So long-term trends are sometimes important to figure out the overall trend. We need to always go with the overall trend and not against the overall trend, right? And what do these longer time frames do? They basically factor out the daily noise in the data. So we just discussed what noise is. So it makes it more clear and it removes all sort of noise. However, they are slow to show changes in the trend. So now that is something you need to keep in mind. If you ignore the daily chart, let's say if you ignore the lower time frame charts, then you might be very late to exit, because the smaller time frames usually show the change more quickly as compared to the longer time frames. So that is the um, contradicting thing you need to keep in mind, right? Now, since we all aspire to become technical analysts, we need to keep in mind that technical analysts rely on analysis on multiple time frames. We do not stick with just one particular time frame, right? We can't just do our analysis only on daily chart and buy only on daily chart. You need to do on daily and monthly and weekly. You need to make some pairs like that, and you need to confirm your analysis on different time frames. Okay, moving on. Okay, now let's see another chart. So this is the weekly chart of Apple again. So you can see Apple first went up, came down, went up again, and it was going up. So now if you compare this chart with my monthly chart, what can you see? You can see that the noise is more in the weekly chart as compared to the monthly chart. Why? Because weekly chart is less, it's a smaller time frame as compared to the monthly chart. And you need to keep in mind that if I am, let's say, taking a trade on the weekly chart, then I need to look at a higher time frame and confirm it with it. Okay, and obviously you know that if it's a weekly chart, then the opening price is the opening of the week and closing would be the closing of the week. And if it's a monthly chart, then the opening would be opening of the month and closing would be closing of the month. Okay, and then we come to the daily chart. Now look at this. Daily chart has like three, look at this, they have three big red candles. Now is it the same with the weekly chart? No, weekly chart went up, it has been going up, and here it's making red. But then there are just last two candles which are red, right? In the weekly, in this. But if you look at this, the daily charts are making big red candles. So you see the momentum in sell off more on the daily chart. Now, why is that so? Because the lower time frame charts give the what do you say, sign, they give the sign very early as compared to the larger time frames. Okay, all right, next let's see what's there to say. So they've just discussed what I just told you, so you can read it if you want to. And you know the upper shadow, you know what shadow is and everything, right? So that is just basic thing. You need to know how to read the charts. You need to go on the trading view and you need to look at the charts and you need to try to put the information which you're learning practically, otherwise there is no point. Okay, now we come to box 1. Okay, I can't really see the box 1. Don't worry about that, I will look it up and try to read it. If you can't understand, it's okay. Just make sure that you're listening to what I'm saying, then there'll be no problem. Box 1. Okay, so you need to see this. So they are basically explaining that the modern software which we have now, you can basically custom change and stuff, right? You can change stuff of weekly and monthly charts or whatever you want to. So but usually what happens is that when you're talking about a weekly chart, you know that every week, every day of the week is included, that is 5 days a week, except for forex is, let's say, sorry, forex is 24 hours, right? So that is the thing with forex. And except for the crypto market, so the crypto market is open 24 hours 7 days a week, it never closes. Other than that, all of the markets close after 5 days a week. So sometimes you have national holidays and stuff like that, but besides that, the opening price of the first trading day of the week, right? So that is something which is included in the modern software. Highest and the lowest price, opening price, we have highest price, lowest price, the wicks of the candles, and then we have the closing price, right? Closing price would be the last day of the week. So what I said, what I described right now is the weekly candle. Okay, and then sometimes you can have holidays and stuff like that, so days like that will just be avoided. Okay, that's it. So that's all they explain. Okay, so now what we they have discussed in the next topic is that how do you work with multiple data intervals. So multiple data intervals is basically a multiple time frame analysis. So what exactly is multiple time frame analysis is you need to confirm your trends with a longer time frame. For example, let's just take a random stock and do an analysis. I'll explain. Do you want to go on gold? Let me take something else. I don't know what to take. Okay, I'll just take US oil. It's fine. Right. So this is my US oil. Okay. Let's say I want to take my analysis on 15-minute chart. So for that, I'll first do a 3-hour time frame, then 1 hour, then 15 minute. So let's go on 3-hour time frame and let's see what's happening. Okay, let's take a period of. Let me just remove all this first. Okay. So okay, look at this. Let's take the period from 17th October 2130 to 23rd October. Okay, so that's the time frame which we are using. Let me make a line over there. Okay, so this. Okay, let's say that here this is what I can see and I'm taking a trade over here. All right, so what will I do? What can I see? The market has been going in an uptrend. Clearly, it's been going in an uptrend, but now the price is slowly starting to go down, and you can see that until now there was a very high, there's a very strength in the uptrend. But then now what happens is the price did not create a higher high, right? If you look at this, let me just. Where's my pencil? Okay. So if you look at this and if you look at this, the price failed to create a higher high now, right? So which means that now we have confirmed that the uptrend has become weak. So if the low is broken, then I want to enter into a bearish trade. So that is, let's say, my view. So what I'll do is I will enter if this particular low is broken. Let me show it again. Yeah, if this low is broken, I will enter because there has been a support in the previous thing also. So that is my view. Okay, so this is my 3-hour time frame and I drew a zone like this on my 3-hour chart connecting the resistance region. Okay, now I'll go on my 1-hour time frame. Now what happens on my 1-hour time frame? Here, right? Yeah. So if you look at my 1-hour time frame, now what is my view here? Below the zone which I drew in my 3-hour time frame, I want a candle to close below the support region and then I will enter. Very simple. So I'm waiting for that situation to happen. Now where did that happen? Look at this. Here finally my candle gave a closing below that region. So now I know I want to enter here. Okay. So I will enter somewhere over there. Let's say I'll go on my 15-minute chart to take the entry. Okay, right. Where did I want to go? Right, we were here, right, when it closes below. So it was, let me just go on the 1 hour time frame again to see the time when it closed. Okay, so my 1 hour time frame 1830. Okay, 1830. So after that I want to enter. After that 1830 candle closed, I want to enter into the trade. So now if I go over here, this is my 15-minute chart. 1830. Okay, so this is my 1830. Now I want to enter as soon as the low of that candle has been broken and my stop loss would be below the high. So then what will I do? I will enter here. My stop loss would be below the candle. Look at this. I would have captured 1 is to 5. 1 is to 5. Okay, I usually book it at 1 is to 2, 1 is to 3, but I'm just showing you the power. So this is what is known as multiple time frame analysis, right? So what did you do? You first made your analysis on 3-hour time frame and then you came back to a 1-hour time frame to refine the zones, and then you came to 15-minute chart to take your entry. So that is the power of using multiple time frames to do your analysis. Okay, all right. Moving on, so that's what they've taken an example and they've explained. Box 1.2, let me see what's there in that. A packet of hourly charts is greatly easy. Okay, so yeah, this is something which is very, very important to note. So when you're going to, let's say, an Indian stock, so this is my Indian market, Shree Cement is a stock in Indian market, right? So if I go on my 1 hour time frame, let's go on my 1 hour time frame. The day started over here at 9:15, and where did it end? It ended at 15:15. Okay, that is 3:15. So when I go on my 3 hour candle, the last candle is always of just half an hour. So that is something which is very peculiar and weird, right? Because the last candle will not be able to complete the 3 hours, right? If I go on my 3 hour time frame. So that charting multiple data sets. Okay. So now what do you understand by charting multiple data sets? So look at this. It's the same graph. On the same graph, I plotted the stock price of Microsoft and the stock price of Apple. So you can see Microsoft has been going up, and so has the Apple been going up. So this shows me that both of the stocks have correlation and they both are going up together. The only difference we can see is that Apple had a major jump here, but when you see Microsoft, it went up, took a break, went up, took a break, went up, took a break. So the rate at which they grew, Apple was like more clear in that. And you can also see that during 2020, both of the stocks took a dump. So that is what. So why do I have to use multiple data sets? So when I plot two data sets in the same chart, in the same graph, then I can basically compare both of them, and I can see and I can make decisions of the same. Now let's look at another chart. So this is BA and this is AAPL, so two different stocks. And you can see that Apple has been rising rapidly, but BA went up, then consolidated. It was in a consolidated zone, and it came down again. So you see how easily you can compare both of the charts and see the movements. Okay, now we come to what is the scatter plot. So again, here we are talking about correlation, right? So there the okay, let me first explain the concept of scatter plot to you. So you need to keep in mind that the price points, the points of price or the points of data information are plotted on a graph, right? And a linear line, a line which is linear, is plotted. And if more and more dots are near to the line, that means that both of them are correlated and the correlation is high. But if the points are scattered across and they are far away from the line, that means that there is no correlation between the stocks. So if you look at Microsoft and Apple, you remember seeing the graph, they were highly correlated, they were moving in the same way, they were very correlated, so their scatter plot would be like this. You can see all the dots are near to this dotted line, near to this linear line, which means that there is high correlation. Whereas in BA we saw that there was no correlation at all. So in that case you can see how the scatter plot is. They are far away from each other, right? So only at one point towards the end they were working similarly. Other than that, there was no similarity between the same. So that, okay, so that's it with the first chapter. We have completed the first chapter, and I'm sure that there is nothing in this chapter which you did not know already. So let's conclude it. In this chapter, we have looked at the choice of data interval and chart construction. Most commonly, technical analysts construct a chart by gathering and summarizing price data at a particular time interval, whether it is monthly, daily, for each minute, or some other frequency. This allows technical analysts to study price movement over time, whether long term trends or intraday price movements are of interest. So, depending on the kind of trader you are, you can choose the time frame. We consider ways other than time to sample and present data in a chart. Now let us begin with the chapter number 2, that is additional charting methods. In this particular chapter, we'll be just seeing what are the different types of chartings. For example, we have the candlesticks, we have the line chart, we have the point and figure charting. So these are the different kind of charts which are available, and how do we use them. So these are the learning objectives. Describe the construction of the types of charts in this chapter. Just a second. Compare the axes and intervals. Analyze trends and price action. Demonstrate how point and figure charts help to minimize the noise. However, point and figure you have already done in the last exam, so I won't be going into that detail, but I'll just discuss it. Distinguish between charts which have a defined axis and which do not have a define axis, state the basic principles behind market profile. Okay, so now something we need to keep in mind when you talk about candlestick charts or whatever we have discussed in the previous chapter, we saw that a particular time interval is required to plot the graph. For example, you need a month of data, you need a week of data, a consistent data. Every week you have a candle, every month you have a candle. But then there are some other kind of charts which don't require a definite amount of time period. For example, the point and figure chart, which we will come to. Okay, so look at this. So a little bit about the history of the point and figure charts is that it has been used from the 19th century. Okay, and it basically does not involve anything related to the timing in the chart. So time periods are not at all important when it comes to point and figure chart. Okay, and the point and figure chart basically just focuses solely on plotting price changes. Okay, so uh, what the point and figure charts have only the changes in the price depicted on the chart. They have nothing to do with the change in time. Okay, so a particular consistent time period is something which is not necessary when you are constructing a point and figure chart. Okay, so now a little bit about how the point and figure chart actually works. So point and figure chart are basically plotted on a grid paper. We know what a grid paper is. The game which we all used to play, cross and zeros. So we use basically a cross and zeros in a point and figure chart. Okay. So on a grid paper you have squares like, just a second. Yeah. So we have squares like this and you plot things like this, right? So this is exactly known as a grid paper. And when we talk about box, this is one box. Okay. This is one box. This is one box. This is one box. So this is known as the box size. How much box size or how much movement is basically given. Okay. So now you need to keep in mind that vertically the price is being plotted and the term box size is used to describe price increment that is used on the vertical axis. The box size basically determines the minimum price movement that must occur for it to be plotted. So let's see an example, you will be understanding what I'm saying. So if you look at this, 50, 51, 52, 53, 54. What is the distance between difference between one box to another box? It is just $1, right? So with each increment in $1, there is one x plotted. So the price is 51 right now, so I have an x here. The price became 52. So my box size is $1. So the moment $1 has been increased in price, then I will plot another x. The moment one more dollar increases, I will plot over here. What if only $0.5 has been increased? Will I plot an x over here? No, I won't plot an x over here. Why? Because the box size is $1, which means I need a minimum of $1 to create a plot. So that is what they are saying. Now, what are these zeros? So zeros are basically the reversals when the price actually comes down. Now, what is the rule for the reversal? Let's see that. So if you look at the last column of X in figure 2.1, plots an increase in price with the highest box, which is 63. You can see that after 63, beyond 63, nothing has been marked, right? So that is something you need to keep in mind. So if you look at it, if you observe the prices like 63.9, 63.75, so that will not add a mark to the chart, right? That's what I just discussed with you guys, that you need a minimum of increment in $1 in order to mark anything. So that's why you won't be marking an X until and unless the price increases to 64 from 63. Okay? Alright. So now you need to keep in mind that timing is not maintained. If in the next 1 second my price increases by $1, I will mark it. If it takes 1 hour for my price to increase $1, then I will mark it after 1 hour. So timing is something which does not matter when you are using a point and figure chart. Okay? So now let's see the reversal things. A horizontal move along the point and figure chart to a new column represents a reversal in the direction of the price movement. So, for example, since we saw that in the figure which we were seeing, it's a 1.3 box reversal point and figure chart. So that basically means 1 multiplied by 3 point and figure. So what happens here is basically that the columns which have X, which means the price is increasing, and the columns which have O's means that the it is decreasing, right? So the last column of X's records increasing price. If the price behavior reverses and begins to fall, a new column to the right is used. Analysts can choose various reversal amounts. So just like how we choose the box size for the increment in dollars, the reversal, the amount which is required for reversal can also be chosen comfortably and freely by the analysts. Okay. In this method, a reversal is recorded only when the price has reversed by at least 3 boxes than the last price marked on the chart. So that means if you look at this, it's at 63, right? So now you need to clearly see the rules of what has been mentioned. 1 point. So 1 point is when 1 point has been increasing, you mark an X, and 3 box reversal. If the price reduces by 3 boxes, only then you can mark an O. If it does not reduce by 3 boxes, you will not mark an O. So here, finally, from 63, the price went to 60. There has been a 3 box reversal, so that's when I will do this. Now again, if $1 has been increased, then I will go up. Again $1, $1. Now again, the price from 63 came down to 260. There has been a 3 decrease, so again I'll mark this. Then again 3, again 3. And then again it's been increasing, from here decreasing. So an O will be marked, and O will be marked only when there is a reversal of more than 3 boxes, and X will be marked when there is an increase of 1. So that is what is the way you plot the point and figure charting. I personally do not use it, but people do use point and figure chart. Let me check if it's there on TradingView. Yeah, it's there on TradingView, but then I think it's there on the premium version. So if anybody is interested in this, then you can check it out for sure. Okay, right. All right. Now that was my point and figure chart. So point and figure chart. So this was one of the price based intervals. So the movement in this chart is solely based on the price, and it has nothing to do with the time frame which is there. Right. So similarly, let's go to another price related interval, that is my range bar. So again, range bars are marked and formed according to the range. So even these bars do not take time into consideration, they take only ranges into consideration. So like we just saw the point and figure chart, that point and figure chart also are used by modern day traders. Like there are people who actually use it, but just because it is less famous doesn't mean that it is not very useful and stuff like that. People do use it. In fact, you guys should check it out, and if it suits you, you should use it. So now we come to range part. So what exactly is range? Range is high minus low. You know that range is basically how much the price has moved in a given amount of time period, right? So similarly, if you look at the range bar, it will have a high, a low, and an open and a close, but each interval is a particular price range rather than a specific time period. As with point and figure charts, price is plotted on the vertical axis, but time is not on the horizontal axis, right? So since we are talking about price based charts, you know that time is something which is not plotted. Usually that's what happens, that time is plotted on the x axis, but here they are not plotting, so you need to keep that in mind. So here the candles are plotted only solely on the basis of the range bars. Let me try and see if it's there on TradingView. Range. Yeah, there's a range bar. Look at this. Now these are range bars. Now you need to choose a range according to what you want. So what is your range? Like, do you want 1 rupee change, or so I will let's discuss the concept, then you will be able to understand the chart better. Otherwise, right now you will just be intimidated. Okay. So each bar interval is a particular price range rather than a specific time period. Okay. So if you see the figure, it is an example of a range bar chart on Microsoft. Notice that the height or range of each bar is the same. This chart was constructed with each bar having a range of $4. Okay, so if you look at it, every single, I don't know if you can see it, let me make it dark. Every single range bar has the same length, right? Why is every single range bar having the same length? Because when a particular m- um, amount of range movement happens, in that case a range bar is plotted. What does that mean? That means that, let's say I want to plot, so what were we discussing when we were discussing the point and figure chart? That if there is a $1 increase or a $1 change, I want an X to be marked. Just like that, in a range bar we are also discussing that if there is a movement of 1 rupee, or let's say if there's a movement of $1, we want a range bar to be plotted. And again, if there is a movement of $1, we want another range bar to be plotted. So that way. So this is what is describing the range. Now, if you look at the chart, you can see that's how it is basically being plotted. So if I have a 10 range bar, look at this. So this is how it will look if there's a 10 range bar. So if somebody is really interested, you should look at it. So the left side is the opening and the right side is the closing, and you must be clear with what is green and what is red. Green is when the opening price is lower than the closing price, whereas red means that the opening price is less than, opening price is more than the closing price. Okay. All right. So if you look at this, the time it takes for a bar to complete varies depending on the price volatility, right? So dates are basically denoted to give the information, but if you look at the ranges, they do not really care much about the time, right? So you need to keep in mind that the range bars are created using daily price data. Okay, so we can tell that the price varied enough over the entire day that three range bars were drawn. So how much range it has been varying, that's what is really mentioned over here. So however, we can't tell that how much intraday volatility has occurred, because that is something which is not clear or not shown in the chart, because it is only specifically referring to the kind of range, right? So that is something you need to keep in mind. So to learn more about the intraday volatility, we create a range bar chart based on more frequent data observations. Shows a chart constructed, which is, let's say if I create a range bar chart using just a 10-minute data, so that will basically show us more details and show us more charts, but other than that it is not there. And volatility, that is characterized by directional price movement, such as price rising by 4, then again by $4, then again by $4. So if something like that is there, then that will basically result in range bars that form an uptrend. Volatility, that is characterized by price rising by 4.5, right, and then it drops by $5, then increasing by 510 only to drop by 5 again. So in that case, what do you understand? It is non-directional, right? So that you need to keep in mind. Moving on, range bars using the 10-minute data. Obviously you can see that the 10-minute data will more cater to the volatile data, right? Okay, so in addition to determine the data interval to use for a range bar chart, analysts must also choose the price range for the bar construction. The smaller the range, the more frequent a bar plot will be, obviously, right? If I want, let's say, just $1 movement, then the range bar might be more frequent. If I want $100 range bar, then in an increase in 100 range might be very infrequent. So like we've been seeing in the examples, so look at the price of Shri. Okay, let me go to a smaller stock because this is a very expensive stock. So if I go on, let's say, okay, let me just go on Microsoft since even they have taken this example. So it's trading at nearly $369. So if I go on ranges, if I go on one range, then you can see that it is very very frequent, because an increase or decrease in just $1 is very frequent. Whereas if I want $1,000, then it's not really that frequent, right? Because you look at this, if you actually consider the price movements of Microsoft, and if you actually consider the range which you want, you need to always see how frequently they are made. So the time, look at this here. So it is possible, but when is it possible? It might take a very long time to be made. So that is something you need to keep in mind. So it might not be that frequent, right? So if you look at it, if you look at the time frames of the same, let me go to 10 range. Let's see the difference between everything. Okay, so 10 range, so the this one was at 229, 18 November 229. Okay, see, look at this. Both, all the three candles were formed at 229. They are all formed 5 seconds apart. Whereas if you go on a 100 range, 214, 216, 218, they are on a difference of 2 minutes. So as you need a higher range or a bigger range, then the timing will also differ of the same. Okay. So the range is up to you. The analyst can decide what range they want to do. They want to take a $2 range or a $100 range. That is up to them. Okay. So what we've been discussing till now was the price based charts or the price based intervals. So we saw the point and figure chart and the range chart. Now we come to something which is known as the activity based intervals. So activity. So what do you understand by the word activity? Activity basically talks about what kind of activity has been done in the stock, what kind of volume has been done in the stock, or what um, like what how did the investors behave in this particular stock. So that, to begin with, we'll start with the volume bars or the volume charts. We already know what volume bars are, I'm pretty sure. The If you look at my chart, the you can see these bars below, right? So these are in general volume, so these basically in general show you the volume, what the volume is. But there is also something which is known as a volume chart, which I'm not sure if it's there on trading view. Horizontal step line, no, it's not there on trading view, but it is a very useful tool. Okay, so let's see the figure. So look at these. So what they've showed is they have volume scaled bars. Now what do you understand by volume scaled bars? Let's read that, figure 2.5. Okay, okay, just look at the figure 2.5. This is of Twitter, right, which is now X. Okay, so this figure basically is another alternative charting technique, and it basically is incorporating volume into the chart, right? According to additional to the price, it is also including volume in it. So this method creates one bar or candlesticks for a particular number of shares or contacts. So this particular method is creating one bar, right, or one candlestick for a number of shares or contracts rather than a set time frame. So here also time is not taken into account. So if 1000 shares are traded, then one bar is made. If another 1000 shares are traded, another bar is made. So like that you use volume scale charts. Here basically, instead of the time unit for every 10 minutes there's a price open low, it's not like that. They basically take into account that how many shares, one bar is created after this many shares are traded. So that is the concept of my volume chart, volume scale chart. All right, now let us start with what are tick bars. Now what do you understand by tick bars? So tick bars are very much similar to the volume based charts. So a tick chart basically uses number of trades to create a new bar. So what is the difference between the tick bar and the volume bar? So volume bar basically has the unit of volume. If this much volume of shares have been traded, then a candle is being made. But in tick bars, if this many trades are made, then a candle is created. So the difference between tick and volume is that volume is not the number of trades. Volume is the number of shares, whereas tick is the number of trades. So that is the difference you need to keep in mind. Volume, I'm just writing it down, you also write it down. Number of trades. Okay, so that is the tick chart. So we know what are the difference between tick chart and volume scale chart. If you are more interested, then please look it up on the net. Okay, now what is a 1000 tick candlestick chart? Very simple, quick revision, which means when 1000 trades have been taken, then one candle is formed, right? So that the the most interesting thing about the charts which we have discussed right now are that they don't care about the timing. Timing is not something which they keep in mind. So maybe that gives clear information, right, to some people. Now we come to the last concept of the chapter, which is the market profile. Now you must have heard about this multiple times, and market profile is something which is used by a lot of traders. And now let's basically start and discuss an overview of what exactly is a market profile. So you know that you need to analyze the price data in order to be a successful trader, right? So there was a person, a trader, who was at the Chicago Board of Trade, that is basically the CBOT. They, he basically, his name is Peter. He basically started something and created something which is known as the market profile. So, what exactly is a market profile? Listen to me carefully. When buyers and sellers are in balance or the market is in equilibrium. When is the market in equilibrium? When the when the supply is equal to the demand, right? When the buyers and sellers are in balance and the market is in equilibrium, a fair price is set. Clear? Buyers and sellers can trade around this fair price, redistributing the security. If an imbalance of supply or demand occurs, price will move. If the imbalance is caused by excess supply, then what happens? The price will fall. When you have an excess supply, what does that mean? Simple supply demand concept. When the demand for something is increasing, then I would want to sell it at a higher price because I know there's demand for the product. So if there is high demand, the price is high. If there is low demand, then the price is slow. The price is low. Similarly, when the supply is high, which means the supplier is supplying a lot of stocks, but there is no demand for it, right? In that case, the price will fall. Price will continue to fall until no sellers are willing to sell at the current level. When the demand exceeds supply, an imbalance in the opposite direction will occur. Price will increase until no more buyers increase. Price movement is viewed as the market players negotiating a balance. Very simple. Supply demand concept. Very basic, right? So now this concept was something which was noticed by Peter, and he tried to study this in more detail and create something which basically understands the price observations around this fair price level. So fair price is the price where you we just discussed that, right, where the market is in equilibrium. So when Peter watched this negotiation, he noticed that uh, price observations clump around a particular price level. That was known as the fair price, right? And then he divided the trading day into a number of time periods and recorded in how many of the time periods each price level was observed. He saw the price distribution often took on the shape of a bell shaped curve. So when he saw the price, he saw that it was like this. So this is also known as the normal distribution. So keep that in mind. So this is the observation which was made by Peter, okay? And he saw that it took a bell-shaped curve with a few observations of prices that were too high or too low to persist across many of the time periods. So they also gave an example of the same. So look at this. So this is basically a forex trader and the market profile of the forex trader. So let's say the example which is given in the book is when the forex trader is basically trading euro USD. So that's what we are also thinking. And the range is from 1.1800 to 1.900. Okay, now what is this ABCD? Let's discuss that. The trading day will be divided into time periods. That's what Peter said, right? So, and Peter also said that each time period would be using some colors, right? And for example, A represents 8 to 8:30, B is 8:30 to 9, C is next 30 minutes. So every letter is every 30 minutes. So during the first 30 minutes, this was this. During the second 30 minutes, this was this. During the third, this. So then what happened? Look at this. what are the price ranges which the price touched during that time period. That, so A is my first 30 minutes. The first 30 minutes the price touched this, the price touched this also, the price touched this also, the price touched this also. So basically let's see till where A is, till here. So the range of the price during the first 30 minutes touched all the price points. Very simple, right? So the price basically oscillated between these 2 points during the first 30 minutes. B is the second 30 minutes. The price oscillated between this and this, right? Because B ends here. C is here and C starts here. C started oscillated between this and this, so on with D, E, F, G, whatever. You know what that is. So this is basically giving you a bell-shaped curve, right? You can see that it's giving you a bell-shaped curve. So this is what is basically said by Peter, and this process basically is continued throughout the day. That's how he basically took out the experiment. And he also said that these prices are observed frequently and represent a balance between the supply and demand and are considered fair prices. A high price occurred, but then you know that whenever the high price occurred, the supply and demand were able to balance. So in order to account for trading in a 24-hour day, the CBOT, the Chicago Board, began using the capital letters A to X to represent the first 24-30 minute periods, and that is how it has been used by the CBOT. Okay, so that is what is my market profile. I hope that is clear, and I hope you understood what I discussed about market profile. It's basically just about the supply and demand, and keep in mind the normal distribution. Now we concluded the chapter, and that just says that individual traders and technicians modify and personalize all charting methods to best meet their personal trading styles and to capture the information most appropriate for the security they are trading. Charts are the technician's tool. It is helpful to become familiar with the various charting techniques and the principles behind them. Once you have understood the basics, you'll be able to customize the charts. So end of the day, it's about you, right? What kind of chart do you want and how you customize the chart? It's all based on the personal preference of the trader. So other people can suggest charts, and we all are basically learning different kinds of charts, but end of the day we need to look for a chart which suits our personal things. I know I said in the starting that we'll be completing the third chapter as well, but I think the video is already very long, so I'll just end it over here. In the next video, I'll do the chapter 3 and 4. Thank you. I hope you understood the chapters.